All right, Manoj, got that. Thank you very much. We'll quickly look at, of course, the street view now that we've had a whole 2 days of a weekend to digest the developments with respect to debt mutual funds. Digant Haria, co-founder at GreenEdge Wealth Advisors, is with us. Digant, thanks for joining in. I think, the market's also trying to gauge the impact on NBFCs and the deeper, wider impact on the bond market. Considering that a lot of this inflow that was coming into mutual funds was obviously being parked in the bond markets, and NBFCs have been big buyers there in the past. What is your own sense? And in terms of, individual stock action, stock impact, what should we be looking at?
Hi, Surbi. Thank you for having me here. I think, I have a slightly different view. We were analyzing the data over the weekend on the liability side of all the NBFCs. Nobody in the market has more than 10% of their borrowings which come from mutual funds. Most of them are between 3 to 5%. So actually, I would say that, whatever has happened over, the weekend, the change in regulations, they actually have no impact on NBFCs. The reason for that is that if you remember the ILFS crisis which happened in 2018, it happened because of the ALM mismatches in the NBFCs. So between, say, 2018 to 20, a lot of mutual funds cut down their exposure very, very ruthlessly to the NBFC sector. And they have been investing more and more in the G-Secs and the corporate bonds, something like a Reliance or, the PFCs, RECs, HDFCs of the world. So I think the impact is really negligible. Maybe the Mahindra Finance, L&T Finance and Bajaj Finance, these are the only three NBFCs which have a slightly larger exposure. But that too, if you look at the absolute amounts, 6,000 crores, 8,000 crores, these are something which these big groups can really borrow from the banks and, go ahead with their routine growth strategies. So I think for the NBFC sector, this is actually a non-event. The event actually happened in 2018-19. So this is hardly an event.
Digant, just repeating the numbers is what you're saying is obviously very, very reassuring. Good to have that clarity. You're saying that no NBFC has more than 10% of borrowings from mutual funds, and the average across the sector is 3 to 5%, right? If I got the number right?
Yes, the long-term bonds, because the rules really impact only the long-term bonds, which is 3-year maturity plus. So see, after ILFS, everybody started managing their ALMs well. Let's take, for example, Mahindra Finance itself. They have 25% which come from NCDs. But a large part of the NCDs come from the insurance sector, which is really that 3 to 7 year kind of money. And maybe 4 or 5% also comes from the retail, which is again 3 to 10 year money. So mutual funds is a very, very small part. And, you look at any large debt mutual funds, long-term debt mutual funds, they mostly have G-Secs. 40-50% is G-Secs. The remaining is these PFCs, RECs, Reliance, the port sector. It's all the heavy sectors, not the NBFCs really.
Digant,
finance, you may feel that the NCDs are 21%, but mutual fund is hardly 2 or 3% of the whole liability mix. So, Muthoot has completely retail out of the 25 to 26% of NCDs.
Yeah. Digant, so let's just come to NCDs. But the point is, these NCDs are also subscribed by mutual funds, right? Not only mutual funds, by other categories as well. So, is there an indirect impact? Basically, will banks have to now depend more? Will NBFCs have to depend more on banks? And will the cost go up? Or you don't think that's a factor? Sorry, go on.
No, I don't really think that will be big because, replacing 3 to 5% or maybe 10% of your borrowings is not really a big deal. See, the smaller NBFCs can go through the co-lending route. The eventual borrowers, you borrow from banks. The larger ones, insurance and pension funds are the really big subscribers. So if you look at LIC Housing Finance or PNB Housing, they have 50% of their portfolios coming out of NCDs. But, almost 90% of that 50% comes from insurance and pension companies who are really long-term in nature. So I think it's a very, very manageable challenge, if at all, for these, 3 or 4 NBFCs. Otherwise, I think, the bigger deal for NBFCs should be the rising interest rates and, what happens to their consumers and the underlying markets. I think what happened over the weekend is hardly going to matter a lot for these NBFCs.
Okay, fair enough. Now, any thoughts particularly in Bajaj Finance and Bajaj Finserv, Digant? not on the back of this particularly, but stocks have been correcting those two names.
I think, Prashant, the stocks have been correcting far before these regulations have come. And I think we discussed once more on your channel that, see, Bajaj Finance is slowing down on growth. Last decade, we were used to 35-40% growth from Bajaj Finance. This decade, they are struggling to do that 25-28% kind of number. And on the other hand, the banks have caught up. Banks from 10-12%, they are growing at 20%. So obviously that valuation shrinkage will happen. Bajaj Finance has a lot more challenges in terms of converting to a bank at a later stage. There's some bit of management shuffling which is happening inside. So I think Bajaj Finance as a stock is still expensive, and unless it can grow at say 30% or so, I think the stock remains in that 5,500 to 6,500 range ballpark. And if the market's correct, you will see more correction in these pockets. And Finserv is obviously a derivative of Bajaj Finance and the insurance part of the Bajaj Group business.
Okay. Any of these names looking really mouth-wateringly attractive, Digant, out of the stocks under your coverage?
See, I think, we are staring at a slowdown. The whole Indian economy is probably on the verge of slowing down. But within all the financial pockets, I think vehicle finance is something which is a bright spot. Microfinance is something which is a bright spot. So if somebody is looking for bottoms-up idea, I think these are two sectors where the macro trends of the sector itself are doing well. So the good players in these sectors will typically do very well. So, a Chola would do well. Obviously, Chola is a little expensive, but, you come down in this Shriram and Mahindra Finance, I think the stocks are pretty cheap. There is a good turnaround in the business which is going on in Mahindra Finance. So over a period of time, I think, these companies can create some wealth because the underlying is good. The companies are in good shape. Similarly, if you look at microfinance, that's the only sector which will probably give you 25-30% kind of growth for FY24. And then, some good players, like a Credit Access or a Ujjivan here can actually, give some solace in the market, the tough markets like what we are seeing today or the last few months.
Digant, thanks very much. Good speaking with you. Vehicle finance and microfinance, two pockets in the space under coverage, non-banks, where one could still look for opportunities. Otherwise, the broader call from Digant is that the overall economy seems to be on the verge of some sort of a slowdown. So keep that in mind. On the debt mutual fund taxation bit, Digant says, well, forget about it. There's not very much by way of an impact in terms of cost of funds rising for non-banks.